Okay, so in this unit we're going to be talking about the not totally natural accounts. As in they sort of do deal with natural persons, the living, breathing humans, but they're a little more complicated than the ones we talked about in the previous chapter. But what is a person? According to securities laws, there are basically two types of persons. A natural person is a living, breathing human being of adult age. They have to be able to enter into a contract. Minors are not considered persons. Dead people are not considered persons. People in a coma. They cannot be judged incompetent or incapacitated. They have to be living, breathing humans of majority age. But they're also non-natural or corporate persons. These are corporations or some other legal grouping of natural human beings together. Most corporations, partnerships, LLCs, things like that are what we know. Trusts as well, as we're going to be getting into in this unit. Trusts, for the most part on the SIE, you simply need to know them definitionally. There's really not a lot of puzzles that they could give you with trusts. It's mostly needing to understand the differences between the types of trusts in the definition. Revocable trusts are trusts that can be changed while the person is alive. They can be revoked. Generally, that means they're not going to have tax benefits because they can be changed. They're not going to get the same benefits as ones that can't be changed, ones that are irrevocable. Revocable can be revoked, can be changed. Irrevocable can't be. They can't be changed while the person is alive. Once set up, they're unchanging. These are the ones that might have some tax benefits depending on the structure of it. Now understand, when it comes down to trusts, you want to get very good at saying the following thing to clients. You ready? Let's talk to an estate attorney. Got a question about trust? That's a great question. Let's contact an estate attorney. None of our licenses, unless we're lawyers as well, none of our securities licenses are going to let us talk about trusts in anything other than the most basic form. Because it's a law position. They are incredibly complicated. There's a whole branch of law that deals with it called estate attorneys, or at least that's part of what they deal with, is setting up trusts and things. These are complicated. We're never going to really deal with them in the real world outside of what we might be helping with an estate attorney. And if you know any, it might be useful trying to build that relationship, especially if you have rich clients or if they have clients that might need insurance or investment planning. But continuing with trusts, there are also living trusts. These are created when the person is alive. These are the ones that could be revocable or irrevocable. Because the other type, the testamentary trusts, are created when the person dies. Clearly they can't really be revocable testamentary trusts because they can't be revoked while the person is alive, but created when they died. Because a lot of times trusts are created by funding from the estate. When the person dies, it creates a trust and their money goes to the trust. It can help at least hide or shield some of the taxes, spread them out over time instead of as a lump sum tax payment that might be rather painful or difficult. There are also simple trusts. These are trusts that must distribute all of their income each year to the beneficiaries of the trust. They cannot withhold that income. They can't hold it and let it grow. Complex trusts can. They don't need to distribute all income each year to beneficiaries. They can hold it and let it grow. Trusts also could be charitable or non-charitable. Charitable remainder trusts are where they are living, it benefits somebody. It could be set up in any way they want, for my benefit, for my wife and my benefit. It could be set up when I die, I'm leaving the charitable remainder trust for my wife, where it is going to pay for her living expenses and everything she needs. But when she dies, or when we die, if it was set up as a living trust for us, when we die, the money then is going to be going to some charity. And these are definitely going to have some tax benefits. What they are, doesn't matter. We don't need to know it. Call an estate attorney. But charitable trusts are the ones that are generally going to have more tax benefits. Non-charitable could still have some tax benefits, but likely not as many. The other type, very much related to trusts, are the UGMAs and UTMAs, the Uniform Gift to Minors and the Uniform Transfer to Minors Acts. These are, for the most part, identical. with exception that UGMA's age is assigned by the state. That's either 16 or 18, depending on the state's definition of age of majority, or an UTMA, which could be set anywhere from that age up to age 25. But minors, as we covered it before, are not actually persons according to securities law. According to everything else, sure, they're persons, we understand that. But according to securities law, because they cannot legally enter into a contract, they are not a legal person and thus cannot legally own property. But they can be given it as a gift. It can be in their name. All other ways between these two are identical. The exception is the age, and I've really never seen or heard anyone having the difference between them actually being tested. So UGMAs and UTMAs, whenever we talk about UGMAs, with the exception of age, we're also talking about UTMAs, have one minor and one custodian per account. The minor cannot legally own property, so there's a custodian, an adult, who is monitoring it as a fiduciary. They have a fiduciary standard that they have to uphold. They have to be acting in the best interest of the minor. All securities, though, are registered in the minor's name. They are the minor's. They're just not sort of technically yet. The contributions are considered an irrevocable gift to the minor. The UGMA account must include the custodian's name, but it's the name and social security number of the minor. These are registered to the minor. It is their social security number on the account form. One minor and one custodian. One custodian could have several UGMA accounts for different kids. If I was going to set up an UGMA account for my two children, I could be the custodian of both of those UGMA accounts, but it could not be in the same UGMA account. Just like I could be the custodian of one of the UGMA accounts, my wife could be the custodian of the other UGMA account, but we can't be joint custodians. It's one custodian, one minor. Now, the UGMA and UTMA is not a place to hide from taxes. There is a small amount of income to UGMAs and UTMAs that is in fact tax-free. But then there's an equal amount that is taxed at a very low rate. I believe that number this year is a total of $2,200. It might be $2,100. In which case, that small amount that is totally tax-free is going to either be $1,050 or $1,100. Then the equal amount, the $1,050 or $1,100, again, is taxed at a very low rate. I believe that's 15%. It's called the kiddie rate, the kiddie tax rate. But once the income is above that low level, it is going to be taxed at the parent's maximum tax rate. It doesn't have a higher tax rate than the marginal rates of the parents, but it skips all of those lower tax rates. In a later unit, we go into more on taxes, but I will have the post about marginal taxes below so we can sort of have a grasp on how that works. But instead of needing like $100,000 or $150,000 to reach the top tax bracket, if the parents are already in the top tax bracket, the UGMA or UTMA is going to reach it there after either $2,100 or $2,200, which is why it's not a place to hide from taxes, because it likely could have more in taxes, especially if the parents are in a high tax bracket. Same taxes, it just reaches the rates higher. But the tax liabilities are the responsibility of the minor. Now, don't think the minor needs to go and get a paper route in order to pay these taxes. If the UGMA or UTMA is generating enough income, enough money to owe taxes, it's also generating enough money to pay those taxes. Taking money out of the UGMA or UTMA to pay the taxes that are owed is a perfectly valid use of the money. A credit card is when is what you use for something that costs too much and you want to pay more for it. Yep, it's the use of a credit card. That brings us to the end of this unit. Next unit, we're going to be talking again more about natural accounts when we're talking about retirement accounts. Things that we will hopefully be doing lots of because they generally deal with large amounts of money, which lets us, I think, have fun in sort of planning and structuring these things. But also, the more money that we're moving in retirement accounts, the more we're making commissions. So we should like to learn about retirement accounts so we can best help our clients with them, because there is a lot of retirement money that is going to need help with. Hope you enjoyed this unit. Talk to you again shortly.